Well, welcome to the Undervalued Investor YouTube channel, where today we're discussing the troubling times facing the Canadian economy and what that presents as an opportunity for investors, especially dividend-focused investors. And if that's a conversation you'd appreciate, hit that like button, because we're just going to read through the article from the inflation data that was just released on Globe and Mail. But Canada's annual inflation rate accelerated for the second month in a row, with both headline and core inflation measures moving markedly higher, Statistics Canada said Tuesday. The Consumer Price Index rose 4% in August compared to a year earlier, pushed higher by rising gasoline and shelter prices. That's up from 3.3% in July and 2.8% in June. A Bay Street analyst expected the rate of inflation to be about 3.8% in August. The Bank of Canada's two preferred measures of core inflation, which filter out volatile price movements, also increased to 4.1% and 3.9%, up from 3.9% and 3.6% respectively. The central bank tends to put more weight on these measures than the headline CPI numbers when assessing if inflation is moving in the right direction. Earlier this month, the bank held its key interest rates steady at about 5%, but warned that it could restart rate hikes if inflation remains stubborn. It's trying to bring annual CPI inflation back down to 2%. Inflation in Canada has retreated over the past year, largely as a result of falling gasoline prices after the spike in spring of 2022, followed by Russia's invasion of Ukraine and the lifting of COVID-19 restrictions. But that's not the only thing. We also have shelter costs, which increased pretty dramatically, and a lot of this is becoming a self-inflicted wound because Canada has been adding carbon tax over the summer, and on top of that, as you increase interest rates, it largely costs people buying homes more, and people that are buying homes to basically rent out, they have to raise those prices obviously on their tenants, right? So all of that just kind of derives to this factor of self-inflicted pain. We also have a lot of immigration in Canada, which is pushing the housing cost up a lot. So the only real tools that the government has at hand is either cut carbon tax and stop letting immigrants in, and these are really tough discussions that I'm really glad I'm not part of the political landscape to deal with it. And I'll pass the question off to you. How do you think Canada is going to manage dealing with inflation? Do you think they're really going to raise interest rates again? Do you think they're going to hold steady into the rest of this year? I'd love to know what you think, but this is really affecting the broader Canadian markets, especially the stock market, as we see some of Canada's largest companies being Royal Bank, Toronto Dominion, Shopify, Canadian National Railway, Enbridge. These companies are historically paying yields we haven't seen in literally decades. I mean, you take a look at TELUS, for example, the telecom giants here. This is one of my favorites. This stock has retreated pretty dramatically from its all-time high. I mean, it's down, I think, somewhere upwards of what, maybe like 20-30%. And then right now the yield on it is 6.2%. To put that in perspective, the last time this company was paying anywhere near close to this high of a yield was during the 2008 financial crisis. And even then the yield wasn't that high. It never peaked up to those levels. You look at something like Royal Bank, for example, which a lot of the banks have been retreating backwards because they've had to put loan loss provisions aside, because obviously as interest rates go up, people have to make higher payments on their loans, which ruins the credit quality of those loans, which makes the bank a little worried, meaning they have to put more money aside in case those loans start to default. As it stands today, most Canadian mortgages have actually proved pretty resilient, and the delinquency rating is actually lower than where it was during the pandemic. And Royal Bank right now paying out a pretty nice yield of over 4% is, again, historically a lot higher for it. It's not out of the realm of where it's been in the past during the pandemic or during 2016, but TD is in another field here as well. You look at some of the lower weighted banks. TD has pulled back pretty dramatically after the fallout of it not being able to close on a regional bank in the US, which I think was First Horizon. And this dividend yield, again, is historically higher than it's pretty much been outside of the pandemic. You look at some of the energy companies like Enbridge, which just purchased a massive company in the US related to basically natural gas. And it has become the largest natural gas powerhouse basically in North America. And it is also the largest pipeline infrastructure company basically globally, spanning all the way from Canada down to Texas in the States. It's a very intriguing company that's been pulling back pretty dramatically with a 7.51% dividend yield. And that historically is pretty much a record for it. Outside of the pandemic, over the last 20 years of this entire company's history, it has never yielded these kind of insane dividends. I don't know if these are going to be truly sustainable, but these companies are profound, infrastructure, heavily baked into our system. I mean, if you walk behind pretty much any place in the city and you see them using natural gas, if you look at the meter, typically it says it's going to be an Enbridge based, a natural gas meter. But you take a look at like Canadian National Railway, and even though this one hasn't retraced a whole lot, if we zoom out on this chart, it's still holding pretty well, but the dividend yield on this one has had time to catch up as they've increased it. And we're talking about a 2% yield on this company, which we haven't seen for well over a decade, again, with the exception of the pandemic. But at this point, I'll pass the question off to you. I'd love to know what you guys think about this. Are you picking up these discounted deals within the Canadian stock market? And do you think inflation is going to persist and it's going to lead the Canadian bank to raise interest rates more? I'd love to know what you think about all of this in that comment section below.